Ethereum should be valued at between $1 and $1.2 trillion. So it's a bit more than double what it is today. This is today. This is not a prediction on the price, but this is a modeling which shows that the price could be probably $9,000 today easily, 2 to 3 times what it is. Its true valuation is not the sum of its revenues, but it's the sum of the world's dependence on it. It's how we depend on it. That's the value. We depend on the internet for email, for publishing, for connections, for communications. And we're going to be more and more dependent on Ethereum specifically. So this requires a mental shift of sorts. And the shift is from a fee-based valuation, which some analysts want you to believe that this is it. We have to shift from fee-based valuation to flow-based valuation. From TPS comparisons to economic settlement.
Welcome to the Edge Podcast. I'm DeFi Dad here with Nomadic. Today's show features William Mougayar, author of The Business Blockchain, entrepreneur, investor, and longtime Ethereum advisor. William, thanks for joining us. How are you doing?
Hi, guys. All good. Looking forward to it.
You have over 4 decades of experience working in technology. I think you have a point of view that allows you to draw parallels to what you've actually seen in those 4 decades. One of the analogies I've heard you talk about is the internet as a public good and how we would value it if it was a company. So now we're talking about Ethereum, which is, I believe, one of the few crypto networks that actually mirrors the value of the internet. And so we're going to talk about how we can begin to value Ethereum as a public good, and really excited just to have you walk us through all your thoughts and ideas on this. Let's start, though, with more on your background. Tell us about all you've worked on, the highlights reel, and then how does that ultimately lead you to Ethereum?
Sure. So I started my career in technology working for Hewlett-Packard for almost 14 years. Then I branched into the internet, specifically in 95. At the time, I wrote my first book in 97 called Opening Digital Markets. Then I wrote another one, which was a glossary of internet terms for executives. Then I, for a number of years, I was a consultant on my own. And then went back into the corporate world and got a taste of outsourcing and offshoring. I was at Cognizant as a VP of Global Marketing. I had a stint at Aberdeen Group as an analyst in technology. And then I became an entrepreneur again. I founded 3 startups. And then in 2011 or 12, got a taste of Bitcoin and the blockchain, obviously, which leads us to my first involvement with Ethereum almost exactly 12 years ago, since I live in Toronto. And as you know, that's the birthplace of Ethereum. Almost exactly 12 years ago, January the 1st, 2014, I remember it because it was an important moment. I met Vitalik, and at the time I used to attend the Bitcoin meetups that Anthony DiOrio used to organize, and Vitalik used to attend those. At the time, Vitalik had just barely finished writing his paper, and we were waiting for the meetup to start, and I started to question Vitalik about Ethereum, and we had a lengthy conversation at the time. And he wasn't even 19 yet. He had just dropped out of university. He had, I think, done a couple of years and decided to take a scholarship and travel the world. And as you know, we all know what I did. And then he realized that we needed more than Bitcoin and colored coins. And having had the experience I had previously, specifically, I had a taste of peer-to-peer technologies in 2001, right after the internet crash. I used to run something called Peer Intelligence, and we were chronicling about 100 peer-to-peer technologies. At the time, it was just mostly file sharing and pirating music, and these were the days of Napster. And with the internet, with the web, the early days of the web, if you recall, there was an early version of digital cash that didn't go anywhere. So I had previous experience in those technologies. And when I saw Bitcoin and Ethereum specifically, I put two and two together, and it dawned on me that this was going to be really big. And more specifically, with Vitalik, what struck me is that Ethereum had there was a human element to Ethereum. It wasn't just about technology. It was about the impact that this technology was going to have on humanity and on humans, on us as human beings, basically. And then I decided to immerse myself completely into understanding Ethereum. I became a close advisor to the Ethereum Foundation. I was close to the team before it was even a team. I was very close to Vitalik for 3 years. We became like reverse mentors. He taught me blockchains every week, and I was advising them on business matters relating to the Ethereum Foundation. And that's kind of how it started.
Grow wealth exponentially. With TOROS leveraged tokens, when the market moves in your favor, your gains become parabolic. They're built to ride trends, auto-compounding profits. With TOROS, it's simple. Pick a vault, deposit, and your exposure is multiplied, maintained, and protected automatically against liquidations. TOROS reduces risk and keeps you in the market ready for the rebound. When markets dip, the vaults auto-adjust, softening losses and preserving your position. Just pick a token to multiply your returns. TOROS Finance, exponential gains with leveraged tokens. To learn more, go to toros.finance. Redstone is building the Oracle backbone to unlock real-world finance on-chain and next-gen DeFi. With modular gas-efficient feeds across over 110 chains, trusted by 170 clients, supporting over 1,300 assets, from value-accruing stablecoins, liquid staking and restaking tokens, to treasuries, private credit, and commodity tokens, Redstone delivers accurate real-time data where it matters most. The biggest platforms and protocols in DeFi today choose Redstone oracles, such as Athena, Securitize, BlackRock Biddle, Pendle, Spark, and Maple Finance. If you're building the future of finance on-chain, you need Redstone's leading modular blockchain oracle layer. To learn more, go to redstone.finance, and thanks to Redstone for supporting us here at the Edge Podcast and Edge Newsletter. Banks use your money to line the pockets of shareholders. Meanwhile, Solstice uses the same yield strategies to line your pockets. Introducing Yield Vault, Solana's best yield. A live delta neutral strategy with positive returns month over month for 3 years. Built for internet capital markets and powered by the stablecoin USX. To learn more, go to solstice.finance. Neutral is the next generation of crypto-native yield. Their synthetic dollar NUSD taps into OTC arbitrage, funding rate inefficiencies, and delta-neutral strategies to deliver premium, stable returns without taking market direction risk. Neutral is now officially live to mint NUSD and start earning neutral points. Learn more at neutral.fi.
Wow, William, I didn't know you were so involved sort of at the genesis moment of Ethereum, and I didn't know you were so close to Vitalik back then as well. Very, very cool to hear. Maybe before we get more into, some of the things that we've mentioned here, Ethereum plus the internet and Ethereum as a public good, I think it's worth just taking a step back and just looking at fundamentals again, because you wrote a piece recently, we've referenced it already, called "The Fundamentals Are Coming to Crypto." And you mentioned how we're moving past these narrative hype cycles. I think collectively, us as an industry are starting to look back and ask ourselves, well, what do we have to show for things? And where can we attach, value to what we've done, and how can we show what things are worth? So maybe you just kind of walk us through your high level fundamentals thesis that you have.
Yeah, I mean, you would think that 15 or 16 years into the evolution of crypto, we'd have something better than speculative factors driving valuations, because this is where we are today. And if you look at the prices, just about anything that is not related to crypto is moving crypto. One day it's geopolitical events, another day it's interest rates. It could be what NVIDIA is doing. It's really not related to the blockchain, and that's the sad moment that we're in. So I kept asking myself, like, wow, how do we get out of this vicious cycle? And then how do we start to take control of our own destiny? And the thing that we have today, unfortunately, there are lots of bad projects and zombie blockchains that are sucking the air out of the attention room. And these companies have many lives. They don't die. If there is a crash, the price goes down a bit, but they're still alive and kicking. Unfortunately, when we had the internet crash back in '99, it really wiped out companies. There was no kidding about it. Companies were gone. Companies that had either bad business models, or were not supposed to be public, they were gone. With the blockchain, it's not the case. There is no roadkill. The only roadkill we have is if there is fraud or crime, like the SBF and other situations. And from a legal perspective, they go. But so many projects are still kicking, unfortunately, because they can print money. So I kept asking myself, how do we value blockchain companies so that fundamentals matter? And when I dig deep into it, I came to realize that DeFi was leading the way. DeFi probably is the first vertical to reach fundamental maturity, because you can look at some metrics today. You can look at TVL, total value locked. You can look at protocol fees. You can look at revenue. You can look at active users. You can look at transaction volume, DEX volume, treasury holdings. All of these have meanings. And these signals are meaningful if you want to analyze the DeFi protocols. So we move away from liquidity-driven hype cycles in DeFi protocols, at least, and we go into usage-based valuation models. So in other words, DeFi is becoming more predictable, and it's not perfect, but it's directionally correct. We're kind of going in the right direction. Then the second sector that I looked at was the centrally managed or the corporate chains, those that are dependent on revenues. And these chains include the likes of Solana and Tempo. They keep telling you, oh, revenues are important. And Solana keeps bragging about the revenues. Fine. Revenues are important for you. Let's value Solana on multiples of revenues. And that's how SaaS companies are valued, because they are run like businesses and they depend on revenues. And if they didn't have revenues, they probably would not do very well. Then the third segment leads us into is Bitcoin. And everybody says, yeah, Bitcoin is a special snowflake. Well, it wants to be a digital gold. Fine. But it's getting its stress test at the same time. If Bitcoin wants to be digital gold, as you know, gold is a good store of value. Why? Because it withstands wars and crises. It has many stress tests, and it does well when it's being tested. Bitcoin keeps getting stress tested week in, week out, and every time it does well and recovers, it becomes stronger. That's fine. Let's leave it alone. But then that brings us to Ethereum, and I came to realize that Ethereum is also a special snowflake, but of a different kind. And that different kind is that it is a public good. At the end of the day, Ethereum cannot be judged by its revenues. It is not a corporate chain. It is not a centrally managed chain. It is something different. And the closest analog to it is not a corporation, it's the internet. So as a public platform, the valuation of Ethereum can be quantifiable because it extracts. It doesn't extract revenues, but it enables value creation at a scale which is the same as what the internet did. The internet did not extract value. It created value for many other companies around it. And that's when I dived into my thesis and the report you mentioned, which is to try to understand Ethereum as a public good infrastructure.
Okay, William, maybe before we even get into this idea of Ethereum as a public good, we talked a little bit about the internet and Ethereum as well in the beginning. So maybe explain to why you think the internet is a good sort of valuation precedent for Ethereum.
Sure. I mean, when we look at the internet companies today, the mature ones, the Facebook, the Google, Amazon, eBay, even the largest SaaS companies, we see some fairly sophisticated ways that Wall Street measures these companies. The fundamentals are real, and they all share things like ecosystem value, network effects, and they have created moats around their markets. And even more, each one is valued differently. Amazon is not valued the same way that Facebook is valued. It's not valued the same way as Google is valued, nor eBay. So there's also been a segmentation that emerged in the internet company space. But we didn't get there right away. It started with some very mundane and very incomplete and very simplistic and even laughable metrics. In the early days, if you were around in the mid-90s, we used to look at internet companies and look at page views or banner ad impression or unique visitors or monthly active users. I mean, these were very crude proxies for attention, but that's all we knew what to measure back then. Revenues came right after, and this is why we're in the same boat today with blockchain. And the most laughable ad, the most ridiculous metric, is probably going to go away, and it's probably revenues for those that are centrally controlled. When we look forward to the future, we're going to laugh at that. It's almost like it would be the equivalent would be valuing the internet based on TCP/IP packet fees. It makes no sense. Or valuing Amazon based on shipping costs. It's nothing that has nothing to do with their business model. So we need more sophistication in the blockchain world. And this is why, back to our previous point, that DeFi is leading the way because metrics in the DeFi space have meaning. When we say TVL, why is TVL important? Total value locked. Because it mirrors assets under management. It's something that is real. Why is protocol fees important? Because it's like revenue. Transaction counts. It's user activity. It's a proxy for product to market fit. The treasuries. Why are treasuries important? It's balance sheet stability. So these are we're not talking things that are not familiar to financial people. So these are real metrics that you can tie.
Do you think one of the issues is the metrics that are being created and marketed as signs of growth and signs of adoption? I do worry about the fact that these metrics are sometimes created, of course, by those that are invested in those protocols. And so there's a game of marketing and pushing that messaging and that framing that here's the one metric that matters. I've recognized as a proponent of TVL, there's a criticism of TVL as not being the best metric for all DeFi protocols. You know, that you could have a more capital efficient AMM versus another one that has a ton of TVL but is not as capital efficient and doesn't have as good of DEX volume. I think we're all trying to get to the best holistic view of these different protocols. And I think you've called out a number of those metrics, not any single one of those being the silver bullet to valuing any single protocol or any single chain.
Exactly. The point is, it's not just one metric. It's a number of them. And the point is that now we have a number of them to look at. And it's the totality of them that will allow one to make a decision or to form an opinion about the validity and the value of a specific, whether it's DeFi protocol or a blockchain. And it's more in a nutshell, it's more complicated than a number.
Okay, so like when we're talking about this kind of asset-specific model, I feel like we're form-fitting the perfect, valuation methodology for our specific asset just to make it look the best. And that bothers me, but I also see that you have to do that because these are totally new, different things. You can't just pluck something out of TradFi and be like, hey, this is how we're going to value Ethereum now. It's like, no, you actually do need to cater to the asset, but I have this like internal conflict that we're just making the best outcome for the asset that we hold, if that makes sense.
I mean, yeah, it might be a short answer. What I would say is that it's an evolution. It's an evolution. And same way with the internet, when we moved off page views and got into other things that were more meaningful, like SaaS companies became more prevalent, and now it's ecosystem. It's going to be an evolution, and as it turns out, the projects that have the most that are the most advanced are going to have the most richness in the metrics, and Ethereum is not a one-trick pony. It has many levels of many layers. And you have to peel all these layers.
And when I just think about this personally too, I feel like I can cherry pick what I think is the most meaningful metric, and it is TVL for me because TVL equates to trust. And like you said, if it's assets under management, where am I willing to put my hard-earned assets? Where do I trust them the most? And that's why I still think TVL is such a pristine metric. Like, sure, great volume is great too. People using and transacting, but hey, where are people willing to store the bulk of their own, personal worth?
But I mean, it's kind of what I would add is that TVL is necessary but not sufficient, I would say, and you need to look at other metrics. It will be a bit like, of course, with banks, like take banks. For banks, one of the key metrics for them is assets under management, because that's how banks are ranked, right? The bigger bank has the most assets under management. But imagine if you were to go to a branch, a bank, a retail, and then you would look at the number of clients going in and out of that bank, and as a measure to see whether there is activity there. But that doesn't tell you anything. For all you know, they could all be going in to withdraw their money. But if there is activity and the AUM is growing, then no, there is activity. They are depositing money and they are taking loans and doing stuff with it. So you need to look at the holistic set of metrics.
I think what we're all getting to is one of the challenges over the years with Ethereum has been this confusion over whether Ethereum is a public good or whether it should be treated more as a company. And I think your argument, William, is that it is a public good. I want to talk more about that. I think that this is where the origin of having challenges to value it come from. You have folks who want to force fit a valuation framework based on how we value publicly traded companies. But Ethereum, I think it clearly meets the definition of a public good because one person's use of it doesn't exclude another, and one person's use doesn't mean that, again, someone else is I guess, more challenged to be able to use that. But can you dive more into this about why is Ethereum a public good? Like, let's talk about that before we get into how you value Ethereum then as a public good.
Sure. Well, Ethereum is the best thing we have today in terms of looking at it as a public good. Ethereum is not a one-trick pony. It has multiple personalities. It has multiple use cases. And depending how you interact with it, you're going to see one or the other. And what's common to this is that it is not a platform that is going to extract value from users. It's the opposite. It's a platform that is giving value to others. And public goods create outsized benefits that are collective. And that goes beyond what any one individual or any one company can capture financially. If something benefits everybody, if it can be used without diminishing somebody else's use, and if it underpins economic activity and innovation, then you have to see it as a public good. And that's where Ethereum shines today. It's a prime example of a public good. It depends on multiple contributors that are outside of Ethereum proper. And who are these critical contributors? It's the client teams, like Geth, Nethermind, Lighthouse, Nimbus, you name it. It's the global research community that are advancing research, whether it's in the zero-knowledge proofs or others. It's the standard process that is producing the ERCs. It's the security reviewers, the auditors that are making the system harder and harder. It's the developers that are maintaining the open source tooling. It's the educators, the documenters that are lowering the barriers to entry. And it's even us, the supporters, the talking heads that explain it to others. All of these are foundational elements, and none of these could be taken for granted. But they are essential, and they have nothing to do with the Ethereum Foundation. It's all around it. So it's not a company. There's nothing central about this. The other thing that we have to understand, like what are public goods? Public goods are defined by three properties. Three. One is there's non-rivalry, meaning one person's use does not diminish somebody else's use. Use Ethereum, anybody can use it. Second one is non-excludability, meaning you cannot prevent access. So anybody can, it's open. So these are two important ones. And the third one is that they are systemically enabling. It means they create more value than they capture. And when you apply those properties to Ethereum, it ticks the boxes. And to give you an example as to why this is the case, in the non-Ethereum world, what is a non-rivalrous good? Like scientific research, knowledge, open source software, GPS signals. If I use the GPS, it doesn't diminish your use of GPS. It's available. Satellite weather, it's available to everybody. TCP/IP packets, it's available. Second category, non-excludable goods. What's an example of non-excludable goods? Street lighting, clean air, base layer internet technology, infrastructure. That is a non-excludable. We can all use it, and we're not competing with each other's use of it. The issue is that markets tend to undervalue what they cannot meter, what they cannot monetize, what they cannot restrict. And public goods, and Ethereum, for that matter, exemplify this paradox. It's a paradox. That's why it's difficult to explain. It's difficult to understand. At least I'm trying to explain it, but people will have to assimilate this explanation and realize that there are some things that you cannot see that are valuable, and we're going to get into that. It's one of the tenets of valuing public goods, because you take them for granted, and when you take something for granted, you only see the value if you don't have it. If somebody takes it away from you, if somebody took away email from you, then you understand really the value of it. Imagine what happens when the internet goes down for 10 minutes. Some people go crazy, right? And you start to value of email and communications. So that's kind of where we are with looking at Ethereum with the public goods lens. But at the same time, it's necessary. It's there. It's an infrastructure. And it enables a lot of economic value externally.
When you say non-rivalry, this is one of the points you're using to qualify Ethereum as a public good. If I were a critic of Ethereum, I'd be arguing, what about gas spikes? How do you explain that? Is it more about where the end state of Ethereum is with the L2 roadmap and the idea that there will be abundant block space, or right now is this maybe a fair criticism that we're not there to that end state?
Well, I think this is more of a tactical element, but eventually, you get in line and you get it, you pay a little bit more and you get it. So it's not really a stumbling block. It would be, the analogy would be if you're driving on a highway, there are some tolls, there are some peak hour fees. It's a fact of life. It doesn't prevent you from using it. It's a little bit more expensive. Uber has peak fees, right? It doesn't stop you from taking it, but you just happen to be there at 5 p.m. or 6, and you just pay a little bit more, but you get in. It's never going to be stopping you from using it. So I'm looking at non-rivalry at the strategic, with a strategic lens, not necessarily only at the tactical lens.
William, I want to dive a bit deeper into Ethereum and the internet. Can you maybe take us into how you think Ethereum mirrors the internet, maybe from an architectural and economic standpoint? And for those listening, we're gonna flash a graphic up on the screen that kind of tells the story as well, that William will be walking through here.
So let's look at the 4-layer birthday cake, basically, of the internet versus Ethereum. At the base layer, what you see at the bottom here, it's really the common basic layer. It's the pipes, it's the fiber, the cables, the towers, the physical network. And both the Ethereum and the internet rely on that. And that's what's common. But that's where the commonality stops. Then each one has its own layers above that. So for the internet, it's well known, the protocols, the TCP/IP is the layer 1 of the internet. And then the access networks, it kind of go on top of that. And then the applications even on top of that. And each layer needs the one below it, right? This is how it works. Each layer needs the one below it to operate. You look at the Ethereum side, the base layer, layer 1, is Ethereum proper, the protocol itself. And then layer 2 is all the layer 2s around, above and around. Now there's almost close to 200 of them, and they keep growing. And then at the top layer, it's the apps and the institutions that are using the bottom layers, whether it's tokenization or DeFi, stablecoin transfers. All of this is on top of the lower architectures. The interesting thing is that what's a public good and what's not? The public good is really the layer 1 only. And if you go to layer 2, the access networks, like in the internet world, is like a club good. A club, you have to pay to get into the club, right? You pay your ISP. You pay for internet access, right? Whatever it is, if it's $20 or $50, Starlink and so on. It's like being part of a club. And in the same way, layer 2s, they have some fees, and you pay that. And then the private goods is kind of the application side. It's kind of a bit more sophisticated. You have to be not just paying an entry fee, but you become a part of it. And that's kind of the analogy. Private, club, or public goods. And the Ethereum is really a public good. And then we can dive into that as well.
So, William, how would you say the internet has been valued up to this point in time?
The MANTLE Global Hackathon is a 3-month competition inviting developers and founders to design and deploy scalable Web3 and RWA products on MANTLE's modular Ethereum L2, built for high performance, low fees, and full EVM compatibility. With $150,000 in prizes and a $30,000 grand prize, now is the time to build. Register by December 31st, 2025. Submissions are due by January 15th, 2026. To learn more, go to mantle.to/hackathon/U4U, and don't forget to follow mantle_official on X.
Katana is an opinionated blockchain. Its opinion is that for DeFi adoption, there are two key things we need: deep liquidity and high yield.
To learn more, go to katana.network. DECIBEL is the new sound of trading, a fully on-chain trading engine supporting spot markets, perps, and yield to trade global markets. Enjoy trustless execution and sub-penny transaction fees. Join the future of trading at decibel.trade and access the Decibel testnet today.
So this is nothing new. I mean, there has been some well-documented and scholarly sound methodologies to evaluate the Internet's worth. And I mentioned them in the research paper, the blueprint of Ethereum that follows the Internet. And it's along three dimensions. The first one is you look at the market cap of the Internet-centric companies. So this is the visible value. So any companies that are Internet-specific. And there, the range is about $12 to $13 trillion when you add them all up. The second factor is the digital economy slice of GDP. Think of it, the flow value. So you think about the fact that the Internet is probably accounting for about 15% of the total world GDP. World GDP is about 110 trillion today. So that's about 16 trillion of the world economy that depends on the Internet per year. So you want to capitalize that on a specific discount rate, and you get $160 trillion. The third item, the third value is what the GDP does not see. It's the invisible part, and they called it the consumer surplus. This is unpriced value, because a lot of the Internet value doesn't show up as revenue. It shows up as benefits. Like, think of the value of search, of looking at maps, of email, of messaging, social platforms, content that's free, Wikipedia, knowledge. And it's been quantified. I'm not making this up. There's been research published in various academic journals, all referenced in the paper that I published. Search engines are valued at, you know how much? $17,500 per user per year in the U.S. The U.S. is a bit higher because the standards of living are higher, GDP per capita is higher. So email is valued at $8,000 per year. Video streaming, YouTube, is valued at $1,000 per year. Facebook, $40 to $50 per month. That's $500, $600 per year. You multiply that by 5 billion users, and you average down, because some countries are more rich than others, right? You get about $1,000 of surplus value per user. That's 5 trillion per year. You capitalize that at 5% discount rate, you get $70 to $100 trillion. So you put all of these together, and you get an Internet valuation equivalent of $100 to $300 trillion equivalent. Imagine if TCP/IP had a token, it would be valued at that. And that's 3 times the annual GDP of 100 trillion, possibly. So that's kind of how the Internet models have been valued. And what I did is I took that and I tried to draw the parallel for Ethereum, and we can dive into that if you'd like.
Just a reminder for listeners and viewers, the report that we're referring to, the title again is The Internet's Blueprint for Ethereum, and that is published by the Ethereum Market Research Center, which William leads. So anyways, we'll put that into the show notes just for your convenience.
Okay, I love this breakdown of how you kind of value these different aspects of the Internet that I've always assumed kind of had an invisible value that I couldn't quantify. So taking this holistically, how would you apply this, what you've done for the Internet, to Ethereum?
So same methodology, more or less, along 3 parameters. The first one is capture value. Capture value is what you see. It's the visible. It's a financial layer, basically. And the capture value for ETH as the asset, the native asset, is as along, again, three pillars. One is consumptive function, the gas. It's gas, right? And the second is a security function. It's a staking. And the third is a reserve function. It's collateral that has a use. So that is something we see. We can put a number on it, and I'll come back to that. The second prong is the economic flow that Ethereum powers. So that flow is dependent on Ethereum. It's kind of the equivalent of the digital GDP. And the economic flow value, today, Ethereum secures trillions of dollars of value transfers, because that's important. It includes stablecoin settlements, you name it, whether it's USDC, USDT, the DeFi liquidity cycles, all the DEXs, the lending, the perps, the options, the structured products, layer 2 roll-up settlements, tokenized assets and RWAs, the NFTs, transactions and royalties, the DAO operations, the identity proofs, attestations, credentials verification. All of this is measured through value settled, not fees collected. Again, fees are just a footnote here almost. So when you aggregate all of that, these flows easily exceed today $50 trillion today. And you capitalize that, and you get $300 billion to $3 trillion in capital value. Now, the third item that's very interesting, and we don't talk about too much, is just trust surplus. That's the invisible layer, and we can pop a chart there as well. And what is that? It's what the users would have paid for trust, minus what they actually pay on Ethereum. So one is high, one is low, and the difference is the trust surplus. And that's real, but it's unpriced unless you quantify it. And what are some examples of trust surplus? Examples: stable coins that reduce cross-border friction, but made by maybe 98%. That's a real surplus. DeFi that eliminates market maker monopolies, for example. Tokenized treasuries that reduce the premiums that custodians dictate. DAOs that make operations more efficient. On-chain identity that can reduce verification costs, for example. Smart contracts as a whole that reduce contractual disputes. So all of these are a measure of trust. So you can think of trust as a monetary premium, collateral premium, and security premium. And you add all of these together, and you have a net trust surplus. And I've estimated it to be between $50 to $150 per year per user. Again, we're not at the internet scale yet, of the 1,000 per year. We're a little bit less, and we have 20 to 30 million users, let's say, for Ethereum, and you get about $1 to $4, $5 maybe billion if you push it in trust surplus per year, and capitalized. It's important. Now, it's not just per user; it's also systemic. Systemic meaning you have tokenized assets. That's 1 to 2 trillion. You have open interest in DeFi. That's maybe 1 to 2 trillion. You have stablecoin flows, another 2 to 3 trillion on the L2s. And you have all of the connected systems, like the EVM connections, that could be $5 to $10 trillion. So all of that, you aggregate everything together. And on the low case, I came up with three different valuations. On the low case, which is where we are today, Ethereum should be valued at between $1 and $1.2 trillion. So it's a bit more than double what it is today. This is today. This is not a prediction on the price. but this is a modeling which shows that the price could be probably $9,000 today easily, 2 to 3 times what it is. Go 4 to 5 years from now, in the middle, and like 26, 27, 28, maybe 29, it can go even higher to $2 to $3.5 trillion. So we move up a little bit. And the high case is in the range between 2030 to 2035, then we can go $4 to $6 trillion. So easily you can see the chart, we can see a value of Ethereum that's a lot more than it is today. If you add all of these different sectors, and this is how we arrive at the true valuation of Ethereum as a public good infrastructure that mirrors the internet specifically.
So if you follow along in the report, I'm on page 25. And so this is where you've unpacked these 3 different pillars of the Ethereum valuation model. Captured value was 1, 2 was Ethereum-dependent economic flow, and 3 was the trust surplus. The most obvious follow-up here is, like, where's the mispricing of ETH coming from? And so is one of these 3 pillars to blame? Like, where do you see the disconnect for the mispricing of Ethereum based on your model? As a DeFi investor, I turn to Maple for permissionless institutional quality yield in a single liquid asset backed by over-collateralized loans. Maple's SYRUPUSDC and SYRUPUSDT are now supported as collateral for enhanced yields on major DeFi liquidity hubs such as Pendle, Fluid, Camino, Jupiter, Morpho, and Aave. To learn more about Maple, go to maple.finance. River is building a chain abstraction stablecoin system that connects assets, liquidity, and yield across multiple chains. Season 3 is live. Earn River points by using SAT-USD in DeFi such as Pendle, PancakeSwap, and Uniswap. Stake River points to accumulate more or convert points to River tokens whenever you like. To learn more, go to river.inc. Hey folks, I want to tell you about our sponsor GEARBOX, the protocol that reimagines on-chain lending. With GEARBOX, you can access 10x credit across DeFi or lend for passive yields with single asset deposits and no impermanent loss. Users can access leverage to margin trade, stake, farm, and more. To learn more about GEARBOX, go to gearbox.fi. Puffer Institutional delivers secure, high-yield Ethereum staking built for institutions. With battle-tested security, granular access controls, and the ability to boost APY by securing multiple AVSs, Puffer gives institutions full control and optimized returns. Puffer is also behind the Unify-based rollup, aiming to transform Ethereum's future in a world where all L2s are working together. To learn more, go to institutional.puffer.fi.
Sure. The mispricing is in the second and the third one. The second one is the flow aspect, because we're not talking about it too much, but I think we need to talk about it, because what's more important is the assets, not just the fees. Again, back to the strength of the balance sheets and the collaterals, and then the trust surplus is going to be increasing, and we have to measure it. Because Ethereum, we don't want Ethereum to depend on speculative euphoria. We don't want Ethereum to depend on traders that see the volatility as a playing ground. And we need to go back to the fundamentals and be able to measure those. So the ways that, unfortunately, markets undervalue infrastructure. Markets undervalue trust. They undervalue neutrality. They undervalue network effects and systems that diffuse, that have a lot of beneficiaries. Because Ethereum is not a one-trick pony. It has a lot of beneficiaries. So how do we quantify that? But that's the unfortunate thing. But we have to make sure that these are more visible. We have to talk about the fact that Ethereum's revenue understates its importance. that it's too good a supply, it kind of obscures a little bit the systemic function that it has. It's the system that matters. The system is very strong, and its decentralization defies corporate analogies. There's nothing like it. The L2's growth in the L2's, it hides the base layer dependencies because it's growing now outside of the core. And the visible activity is important because it's about the institutional flows. And all of these valuation models will trail the economic role. But we have to talk about it because it's a public infrastructure that is valuable. And the way I look at it is that you have to look at to Ethereum as thinking that its true valuation is not the sum of its revenues, but it's the sum of the world's dependence on it. It's how we depend on it. That's the value. We depend on the internet for email, for publishing, for connections, for communications. And we're going to be more and more dependent on Ethereum specifically. So this requires a mental shift of sorts. And the shift is from a fee-based valuation, which some analysts want you to believe that this is it. We have to shift from fee-based valuation to flow-based valuation. From TPS comparisons to economic settlement. That's more important. From short-term revenues to long-term trust minimization. As we get used to these new systems, we trust them more. And it's not about blockchain competition and comparing speeds and feeds. It's about institutional adoption and the impact and the growth of the digital GDP. That is what Ethereum is enabling. And we need to look forward. The next wave of on-chain activity, institutionally speaking, is going to include tokenized money market funds, tokenized treasuries, tokenized credit, private debt, all the ETF products that are continuing to grow, proving on Ethereum, corporate treasuries, using Ethereum for hedging, central bank collateral networks. We've barely scratched the surface there. AI agents. AI is going to be a big front end to interacting with on-chain assets. A lot of people criticize the user interface and the user experience on blockchain wallets specifically. AI has already figured out the user experience. We don't have that issue. Imagine now a layer of AI on top of a wallet where you just talk to it in English and you ask it to create an asset or to transfer an asset. Machine-to-machine commerce with the trust in the middle and prediction markets that are embedded. Not just kind of you go and you read about the prediction markets, but they become part of a transaction. So in the same way that the internet has organized information, Ethereum is organizing value. That is why, in my opinion, the future of Ethereum is to be measured in trillions, not billions. And that is not an ambitious goal. It is something that is unavoidable. Unavoidable. We are going to get there.
William, I just want to say this is such a fascinating model to me, in part because we've been having a lot of discussions on this podcast about the intangibles of Ethereum. And, we talk about them ad nauseum, like the uptime, the multiple client diversity, and all this stuff that I think very hard to measure. And I actually haven't seen anybody try to measure it or quantify it. And I think this is the closest I've seen to somebody actually measuring those intangibles with a really interesting and unique model. So, just like kudos to you for kind of coming up with this, this is like a primary research model piece. And, of course I would say this as somebody that holds the asset and I like the outcome, but I think it tracks, it all tracks the whole way through. So, very interesting approach, and a new approach that I really personally haven't seen applied to to Ethereum.
Yes, thanks, guys, for allowing me to amplify and explain these messages, because it's all about education. And when something is complicated, when something is not a one-trick pony, it takes longer to explain it. In the same way that if you ask anybody what does the internet mean to them, you will get a different answer depending on their experience with it. For some people, it's publishing. For some others, it's communication. For others, it's a transaction platform where they see it as a financial network, and so on and so forth. The same thing is happening with blockchain and Ethereum specifically. It's more than a one-trick pony, so it requires a more sophisticated lens. And depending on how you interact with Ethereum, you are going to have a different answer, and you are going to see it differently. And that's what's important, to see it in a more sophisticated and in a more multilateral and multi-level lens. And that's the right way of looking at it.
Yeah, and I think something that we're seeing, I think everybody who's paying attention, is that institutions are starting to realize this trust surplus. They're starting to gravitate towards these intangibles and see their worth. And again, hard to quantify that, in numbers, but qualitatively, they're choosing Ethereum or Ethereum L2s time and time again, right? Like we just had Johan Kerbrat from Robinhood on, and he basically explained their whole reasoning of picking to develop on Ethereum L2, and fascinating to hear it firsthand from him. And he's an engineer, and like have him walk through step by step their mental process there. But again, yeah, by and large, I think we're just starting to see even more institutional awakening on what's happening in the Ethereum sandbox. So, yeah, I think they're onto your model.
William, could you apply your valuation framework here for Ethereum to other blockchains, something like Bitcoin?
I mean, Bitcoin wants to be digital gold. So you can't apply digital gold valuation in the same way that if something else is being valued as an infrastructure. So for Bitcoin, the digital gold analogy means that it has to withstand stress and crises around the world, and it has to be this sort of value. So to sum it up, Bitcoin is a one-trick pony. It's a digital gold, that's it. Whereas Ethereum is a multiple tricks pony, and it's an infrastructure that does a lot of things. Now, if other blockchains want to mirror this valuation framework, be my guest, but they will not be as rich and as perhaps there won't be as many metrics available when you look at each one of these prongs. And they will fall short perhaps. But yeah, I'd be happy to compare the Ethereum flows to whoever is behind them. And sure, let them be compared. But Ethereum will be on top.
Guys, I think this is a great place for us to start to close out. So first, I want to remind our listeners they can learn more about the Ethereum Market Research Center by going to ethmrc.com. That is where they can find the link to the report, The Internet's Blueprint for Ethereum. We will also link that in the show notes so you can easily find it. Follow Ethereum_MRC on Twitter. Also, check out William's personal site, which is where you can find awesome blog posts like the fundamentals coming back to crypto post we referred to here. That's at wamougayar.xyz. And then lastly, follow William's handle on Twitter. It is WMougayar, MOUGAYAR. William, thank you so much for coming on and talking through some, really complex topics. Really would love to have you back in the future. And I just want to give you the final word before we go.
Thank you, guys. I really enjoyed the conversation, and the best is yet to come.
Thanks, everyone, for tuning in. To stay up to date with future episodes, plus get expert tips, strategies, and exclusive content, subscribe to our free newsletter at the-edge.xyz.